Good afternoon, everyone. Thanks for joining us for Demand Stays Strong for Cash Balance Plans. I just have a few announcements for those of you who are requesting credit. Please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CPE, CIMA, CPWA, CIMC, RMA, CFP, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we do not get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive an email with a link to replay today's broadcast. Let's get started. We are joined today by Dave Baer, National Director of CPA Markets at Pentegra. Dave has over 30 years of experience in the financial services industry. His vast degree of knowledge and enjoyment for helping advisors better assist their clients and expand their practices has made him the go-to expert for 316 fiduciary outsourcing and TPA services. Dave, let's start talking cash balance plans.
Thank you. Thanks, everybody, for joining. Boy, I like that picture. That's when the hair on my head and on my face was still brown rather than gray or white. So today we're going to talk about capturing the opportunity in cash balance plans. And for those who have been to these webinars before or who have listened to me speak about this topic before, there are a couple of different flavors, if you will, of cash balance plans. One flavor is the what I call a wealth building cash balance plan, or a type of cash balance plan that a business owner would adopt in order to dramatically supplement their retirement portfolio. The other type of a cash balance plan is used to modernize or de-risk an existing traditional defined benefit plan. We won't be talking about that type of plan very much today. We will mostly focus on the wealth building cash balance plan for business owners. And go ahead and get started. So what is a cash balance plan? Well, it's a defined benefit pension plan. And so the next question might be, well, what is a defined benefit pension plan? Most of the folks on this call are probably very familiar with 401k plans or 401k profit sharing plans. Those are defined contribution plans. So a defined contribution plan is a plan that an employer adopts to allow employees to put contributions from their own paycheck into a retirement account, and also allows the employer to make what is in most cases a discretionary contribution on behalf of the employees. But the point of a defined contribution plan is that what is defined is the contribution going in today, and what is available for the employee at normal retirement age is the combination of the contribution that went in today and any earnings that occurs or any losses that occur over that time period when they pull it out and spend it as income. A defined benefit plan works very differently. A defined benefit plan targets a future benefit. The plan, by definition, looks out into the future and says, the plan is going to provide X benefit to owners and Y benefit to all other employees, or some other combination thereof. You can almost think of it as working like Social Security, in that the federal government says, based on your income, you will get this benefit at normal retirement age, and we guarantee that there will be money there, so to speak. Well, the employer does the same thing with a defined benefit plan. the defined benefit plan guarantees a future benefit that is defined in the document, and it's based on an employee's age and their wages until retirement, and various other factors. So a cash balance plan, getting back to the slide, is a hybrid defined benefit plan, but it is 100% company funded. It is portable, however. It's more portable than a traditional defined benefit plan. A traditional defined benefit plan often reads, if you work for the company for this many years, you will receive this amount of monthly pension from the plan. The cash balance plan, the math is similar, but the cash balance plan focuses entirely on the cash balance that a participant's account will have when they reach normal retirement age. So it's a hybrid plan that is 100% funded by the company, but it is portable. It's more easily rolled over to an IRA than a plan that is very specific about monthly benefits. The company guarantees eligible employees a specified benefit, the specific crediting rates, and cross-testing methods enable the company to skew benefits to different employees. So many of the folks on this call are probably familiar with new comparability profit sharing or cross-tested profit sharing that allows different amounts of contribution to be allocated to different groups of people or even different individuals who work for a company. Cash balance plans can work in a similar way. Cash balance plans have been around for a while now. I believe they actually came about in the 1980s. This slide gives a little bit of history about retirement plans. 1,337 cash balance plans as reported by IRS filings in 2001, and over 20,000 cash balance plans as reported by IRS filings in 2020. 90,000 small DB plans, kind of considered the cash balance plans of today. There are very few, or fewer, I would say, traditional defined benefit plans being adopted by smaller employers today, say employers with less than, let's just say 100 employees. Much more, or many more cash balance plans being adopted. Current trends indicate that cash balance plans are topping $1 trillion in assets with over 12 million participants. Before we go into different pieces of it here, let's talk about the why that is. Traditional defined benefit plans are highly sensitive to interest rate changes. Now, we've been for the last couple of months on an interest rate increase, but prior to that, for many years through this bull market, we were experiencing decreases in interest rates and interest rate markets around the world and around the country. So traditional defined benefit plans are highly influenced by changes in interest rates, whereas cash balance plans are less sensitive to changes in interest rates. Both plans declare an interest crediting rate within the plan, but cash balance plans are only sensitive for the year in question rather than all the way to a target retirement age. So imagine, if you will, if interest rates go down by 1%, a traditional defined benefit plan could have their minimum funding increased by as much as 14 to 15%, whereas a cash balance plan is relatively unaffected by a change in market interest rates. Back to the slide. So if we look at cash balance plans and where they fit kind of in the dynamic, if you start on the far left-hand side here, we have W-2 payroll income, Roth or pre-tax 401ks. And I apologize, yes, I know that the The 2022 limits are increased. These were the 2019 limits that were built into this slide when it was prepared by the Retirement Learning Center. But nonetheless, we have 401k deferrals on the left-hand side. If you think about retirement plans, and then in a defined contribution plan, there can be an employer match that can be discretionary, could be safe harbor, could be a fixed match, could be multiple matches, not mentioned here, but an employer can have multiple matches in their plan rather than just one match. Could be non-elective contributions or non-elective safe harbor. It's kind of the middle section there. And then on the right-hand side of the defined contribution slide, you see, or the defined contribution section, you see discretionary profit sharing. The idea here being that an employer, a business owner, let's say, who is also an employee, could defer $19,500 last year, $20,500 this year, $6,500 in catch up. There could be, and likely is in a small business, a safe harbor contribution, and then there could be profit sharing contributions on top of that. The point, however, is that employer is going to top out in the $50,000 to $60,000 range of contributions for themselves, whereas a cash balance plan, again, it's 100% funded by the employer. It does have some minimum and maximum funding limits. There are guarantees that are specified in the plan, but the amount that can be funded for a cash balance plan far and away exceeds the amount that can be funded for a defined contribution plan. They are two separate plans with separate governing documents, but they are what we call paired or joined together, if you will. And the reason for that is that the requisite non-discrimination testing that's applicable to both a 401k defined contribution plan or profit sharing plan and a cash balance plan is more easily passed when the two are held together, so to speak, when the two are paired together or they work in a marriage together rather than just having the cash balance plan by itself. So here's a slide about, again, how do they work, and the employer may apply maximum eligibility and vesting requirements to a cash balance plan that can be separate than the eligibility and vesting requirements of the defined contribution plan. So the 401k profit sharing plan might have a 6 months of eligibility or 90 days of eligibility or whatever the employer might want for eligibility for the 401k profit sharing plan. And the cash balance plan could have a different eligibility schedule, could also have a different vesting schedule. In fact, where a 401k profit sharing plan can have as long as a 6-year vesting schedule, the cash balance plan cannot have a vesting schedule that's any longer than 3 years. And vesting, for anyone not familiar with the term, means ownership. So first there's eligibility to become eligible to get into the plan. Then there can be eligibility rules for getting a contribution. And vesting is in a way is an eligibility rule for, it determines when an employee owns and what portion they own of the contribution that's been made for them, for the account balance that's established for them. For self-employed individuals, earned income can be considered for benefit calculations. A self-employed person that's not a corporation may not have what's commonly referred to as W-2 wages. The TPA and actuary provide analysis for employee census, build the plan design. At least here at Pentegra, we don't let an employer adopt a plan before they know how it's going to work and what that is going to look like. And we're going to show you a case study example in a few minutes as to what that looks like. Employer makes annual contributions typically after the end of their fiscal year, but sometimes employers do pre-fund a little bit of the plan during the year, depending on whether they have rules that are applicable to an employee being employed on the last day of the year or not. Assets in the cash balance plan are invested in a single pool, and you'll hear we'll touch on this here and again throughout the broadcast, where individual employees are allowed to make their own investment choices with their 401k plan or their 401k account. They're not allowed to make any investment choices with money in a cash balance plan. Cash balance plan assets are invested according to the trustee, and the trustee is often the employer, but it could be a corporate trustee, or they could engage a financial advisor as an investment manager under ERISA 338. TPA, as you might imagine, we keep records of all the benefits due each employee in the annual compliance. We perform all the annual compliance testing. So, quick test question. Which plans are or are not required to pay PBGC premium? And while the poll is open, I'll just go ahead and describe that. PBGC, Pension Benefit Guaranty Corporation, PBGC premium or coverage is required on all defined benefit pension plans unless they qualify for an exemption. And hint, hint, you're looking at some of the exemptions. So this is, we're not covering this anywhere else in the slide deck, but we are covering it here just to see, just so you can have some fun and see how much you know. I think the poll is open for 30 seconds or 60 seconds, something like that. I think we'll go ahead and move on to the next slide, Howard. I'm sorry.
Nope, no problem. The poll will be closing shortly.
Okay, thank you. You want me to stay on this slide until the poll closes?
Yes.
All right.
All right, the poll is now closed. Dave, you may continue.
Thanks very much. So I mentioned this a minute ago, why 401k cash balance combo plans, combo meaning, paired with a defined contribution plan. Again, employer contributions are deductible in any event with these plans. And a well-designed plan should result in a net savings to the business. And we can talk about this in a minute, but if you, we'll wait for the case study, and I'll dive into a little bit about how the tax savings affect the overall net effect for the business. Competitive employee benefits and golden handcuffs for highly compensated employees are always beneficial. And I mentioned a minute ago that these plans can be designed so that different employees receive different benefits. It's not uncommon for an employer to say, I need to use this plan, or for, let's say, a business owner to say, I need to use this plan to maximize contributions to myself because I haven't saved enough for retirement. I have 4 or 5 key employees in my management team that I need to provide an extra benefit for. And then I want you to calculate how much do I need to provide as a minimum for all of my other employees. Now, I may, as a business owner, choose to give more than the minimum, but I wouldn't be a prudent business owner if I didn't start with understanding what the minimum is. So that's the type of well-designed plan that we're talking about here, is to ask questions, collect census data, build an analysis, target those key employees if necessary, and show the business owner what's going to be available for them at retirement. Because it's an ERISA covered plan rather than, for example, a non-qualified deferred compensation program, the benefits are sheltered from creditors and from bankruptcy. And as you might imagine, tax efficient exit planning makes a more marketable business strategy if you're a business owner and you have all your eggs in one basket. If your net worth is wrapped up entirely in your business and you have nothing else, then it is more and more challenging for you to market that business. So having a plan like this with sizable assets is not only a benefit to a business owner at their retirement, but it can make their business more marketable because of their perhaps lessening their need to hold out for larger and larger sale prices if they go to sell their business in retirement. So step one in creating a winning combination, we always say, is to max out the 401k benefits, and that usually involves a safe harbor and a profit sharing contribution. I think most of the folks on this call understand that 401k plans at their core are tested. A lot of non-discrimination tests are applicable. The actual deferral percentage test and the actual contribution percentage test, ADP and ACP tests, apply to deferrals and to matching contributions. 402G limits are applied to deferrals. So the point is that most business owners can't properly fund their personal retirement with 401k contributions alone. They normally have to adopt a safe harbor provision in order to be able to use their full deferral capabilities personally. And what we're going to talk about is profit sharing as well. And then we layer, if you will, a cash balance plan on top of that. Both plans are separate, but they are tested together for compliance. And that's something I touched on a little bit ago, and I'll kind of describe it a little more here. Why do we have to have two? I've been asked that many times over the last 38 years. And it's very simple. So testing for any defined contribution, for any retirement plan, for any ERISA retirement plan, non-discrimination testing is used to determine the benefit, if you will, that is derived by highly compensated employees and non-highly compensated employees. That's the general division of the population. Highly compensated employees are always business owners, family members of business owners also employed by the firm. Business owner means 5% or more owner. Also refers to employees who earned more than $135,000 in the prior last year. That's the rule for this year. and the testing can either be the testing can either use the current year contributions, or it can use the future benefits derived from those contributions, where we actually project current contributions out into the future to a normal retirement age. This is an actuarial computation. Determine what the benefits are. We did determine the relevant benefits of each employee and each employee group, and we compare those to each other to determine whether the plan passes or not. So the cash balance plan uses a very low interest rate for that future benefit projection. The defined contribution plan, particularly the profit sharing plan, can use a higher interest rate for that future benefit projection. By and large, in the dynamic of a retirement plan built this way, cash balance plan and defined contribution plan, we have older owners and younger employees. That's not the case always person by person, but it's more often than not the case holistically within an organization. Most of the time, most of the owners are older and most of the employees are younger, or the average age of the employees is younger. So if you think about it, if we're projecting a benefit out into the future, the older owner has fewer years. The younger non-owner has more years. until their normal retirement age. So we steer the contributions for the younger owners to the profit sharing side. We steer the contributions for the older owners to the cash balance side. Again, I said the older owners have fewer years to retirement. So fewer years means it takes more money. It takes more current contribution to get them to the same place, to the relevant future benefit that we're testing for. Conversely, the younger non-owners have more years. More years means we can give them less money because they have more years to accumulate funds. We can also use a higher earnings rate when we're making that projection. So that's how that's why the two work hand in hand to pass testing. Older owners, younger employees, lower earnings rate, higher earnings rate means we can give older owners more and younger employees less, and yet they will have the same relevant benefit relevant to their income at normal retirement age. That's the discussion of the testing. We're talking about limits a minute ago. This slide has been updated. So again, let's take a look at the age 55 to age 59 bracket there. That person is eligible for catch-up contributions, so they can contribute up to $27,000 into their 401k deferral buckets, if you will. The 401k with an employer profit sharing, and part of that profit sharing is likely going to be a safe harbor, but the total contribution then can come to $67,500. That still may not be enough for, say, a 59-year-old to retire when they're 62 or 63 or 64 or 65, whatever their goal is. But if we add a cash balance plan onto it, their total contribution could go up to $277,500 for themselves. Okay, $210,000 of that being the cash balance contribution that would be allocated for their future benefit. The disclaimer at the bottom of the page makes note that the information is based on a normal retirement age of 62 or a current age if older, 5.5% interest and applicable mortality. After normal retirement age, 5.5% interest up to normal retirement age, and a maximum compensation for 2022 of $305,000. So again, this has been updated for the limits, gives you an idea where we're going. But you can see some pretty dramatic contributions. Look at that age 60 to 65 bracket, perhaps as much as $342,500 for that business owner who has a profitable company and the ability to make contributions like this. So I'm going to go into a slide on it with a case study, and I have to move something around on my screen so I can see what I'm looking at. I know you don't see it, but I was looking at something blocking part of my screen. So in this case study, we're pretending this is a perfect world example. Everything works out, swimmingly. Here we have this professional service group. This could be a doctor's office. This could be an architect. This could be a CPA firm. This could be a law firm. Could be all kinds of things. Doesn't have to be any of those, but it could be. We have 3 owners, and we have 1, 2, 3, 4, 5, 6 employees. And we have wages that range from $20,000 a year up to $130,000 a year for different people. And actually, I misspoke earlier. The highly compensated limit, at least for this, is $130,000 a year. So we have 4 highly compensated employees. We have the 3 owners and the person down at the bottom of the screen, maybe a manager or something like that, who is also considered a highly compensated employee. So Let me walk you through this dynamic. We have earnings for our owners ranging from 155 to 285 in this example. And let's skip over to the 401k deferrals. Let's just cover up, if you will, the cash balance column for the moment. Mentally cover it up. The 401k deferrals, we have our people over age 50 utilizing the catch-up. Our person under age 50 not utilizing the catch-up. And again, this chart was built with last year's limits rather than 2022 limits. This is a safe harbor plan. So the safe harbor allows our HCEs to defer as much as they want, regardless of the amount that the employees are deferring. And there's also a profit sharing component involved here. So now let's look back at the cash balance column, and you'll notice that we're giving different cash balance amounts to these different employees. These amounts are determined based on their wages and their ages, and more particularly their years to that age 62 normal retirement. And actually, we went normal retirement with a certain number of years minimum, which is why you see age 63 for the older owner there. But you see different amounts for the cash balance plan. Now, these different amounts were based on their ages and wages. We could have levelized the amount for all of them. Let's say they came back and said, no, we're equal partners. We get different salaries because we bring in different amounts of work to the business. In other words, our 59-year-old brings in the most new business to the company, so he gets paid more than the other two. But we're equal owners. We want that to be equalized. Well, that's a possibility. We could equalize this number here rather than have it different per person. You'll notice that we've allocated a small amount, a flat dollar amount of $1,000 in cash balance contribution to everybody else down here. And often this is what we do when we're building these ideas. So what we do is we start with, what are we trying to achieve for the owners? And then what do we have to give everybody else to make this work? And in this example, while we were doing this, we took a look at this person, our 40-year-old HCE, and if you'll notice, they're only getting a 2% profit sharing. That's our non-owner, highly compensated employee, whereas the other employees are getting 4%. And this came about through testing. What happened was that if we tried to give this person the same amount as these people, then we actually had to raise these people. So if these were getting 4, these were getting, I don't remember the exact number, but it was maybe 4.6 or 4.7, something like that. If we try to give this person the same amount, then these were raised again. That was through a testing dynamic. We didn't want to lower our owners, so again, in this example, this is what we did. And while you cannot discriminate against a non-highly compensated employee, you can discriminate, if you're a business owner, you can discriminate against a highly compensated employee so long as you're meeting the top-heavy minimums if the plan is top-heavy. And I'm not going to go into too much detail, but this does do that. This solves for the top-heavy minimum because we're getting a 3% safe harbor contribution and we're getting a minimum 2% profit sharing contribution. So we've solved for top-heavy when a cash balance plan and a profit sharing plan are combined together. Okay, so going over here, you see we've got some big amounts going to our owners. We've got not an insignificant contribution being made to our employees. But let's go down here to the bottom, because this is where I think this analysis really provides a lot of benefit. So we took these 3 employees, and notice this column P over here, principals. This is not an ERISA term. This is just a term that we coined, if you will, so that we could in a summary, separate our key people, and we didn't want to use the term key because, of course, that harkens back to top-heavy testing. But we wanted to call them principals. So our 3 owners are our principals in this analysis down here, and everyone else is a non-principal. So if we go across here, we're giving $606,000 plus in cash balance contributions to our principals and $7,000 in contributions to our non-principals. The deferrals are what they are. Employees choose to do whatever they want. You notice we have pretty modest employee participation in deferrals, and that's not an uncommon scenario. Our safe harbor, everybody's eligible for the safe harbor, and everybody's getting a little bit of a profit sharing. But if I come over here, then I've got a total benefit being derived by my principals of $710,296 and a total benefit for my non-principals of $57,750. The employer cost column, that's really the employer contribution. What we're talking about there is the cash balance, the safe harbor, and the profit sharing. Those added up. Again, that's $638,796 to the principals, our owners, $32,750 to our non-principals. That means that 95% of the total employer contribution is going to our principals, with only 4.9% going to everybody else. So imagine, if you will, now. So let's pretend I'm an employer, and I'm looking at 671,546. Okay, 671,546 is my total contribution, and let's imagine that my effective tax bracket as a business owner is, I'm going to pick an arbitrary number, is 35% times 35%. So that means that I've got $235,041 in tax savings, right? I have spent $671,546, but I have tax savings of $235,041. So if I take my $638,796 and I subtract my tax savings, I have a cost after tax savings of $403,755. But my owners are getting a benefit of $638,796. Now, for all of our CPAs in the room, I understand that I just broke every rule, right? This is in a fictitious bubble that I created, to provide this analysis. But the logic, even if the numbers aren't correct, the logic is true. I have $671,546 in money out of pocket, but after my tax savings, I actually have less than that out of my pocket. I have, let's just say, in the range of $400,000, but I'm keeping $638,796 for my future retirement. That's leverage, is the term that I like to use. That's leverage that can't be duplicated with nearly any other benefit plan, regardless of how it's structured. So that's why we provide this type of analysis. And I say we, I'm going to say as an industry, because Pentegra, of course, is not alone in this industry. But by and large, as an industry, we provide this type of analysis so that business owners understand the full benefit as they're going into it, and they have a great idea of what it's going to cost them. Now, things can change. Notice we have some young employees over here who have very low wages, and that, in a large sense, is how we're passing our testing. I'm going to actually, instead of going to testing, I'm going to go this just to make note that this that we showed for employers that have employees is also available for sole proprietors who have no employees, solo owners, if you will. Solo, what you would normally think of as a solo 401k type candidate, an owner age 40 with 285 of income can still have some pretty significant cash balance contributions along with their deferrals and profit sharing. And of course, safe harbor isn't necessary because they have no employees. But the idea here is that they could have a self-employed person with no employees could also have a plan like this. Where I was going with that testing discussion was what happens if we have changes to our workforce? What happens if my company changes? What happens if my industry changes? What happens if my income or revenue changes? Because we said something early on about defined benefit plans. They have fixed annual contributions. The plans are designed to guarantee future benefits to employees. Even if the choice is not to take, and by the way, with a cash balance plan, the choice is almost never to take the annual income from it. The choice is to roll the money to an IRA. That's what we meant earlier when we said that the plans are portable. Their benefits are nearly always rolled to an IRA. But what happens if things change and I can't contribute this? One of the greatest urban myths that I answer almost every year is, Dave, I think as I understand it, the cash balance plan has to be run for a minimum of 3 years or a minimum of 5 years. You won't find that rule anywhere in IRS code or in ERISA. But you can make changes to a plan to accommodate changes in a business need. But let me talk about the number of years and that sort of thing here. Like I said, nowhere in ERISA, nowhere in the tax code will you find a rule that says it has to be run for this many years. What the reality of a defined benefit plan is that when a business terminates a defined benefit plan, it's a more formal process than when they terminate a 401k profit sharing plan. When you terminate a 401k profit sharing plan, you choose to terminate it. You have a resolution to terminate. You amend your plan document to terminate. You make notice to employees. You end the plan. You file your final 5500. You perform your final testing. You close out all the accounts, and you're done. You don't necessarily have to seek a formal determination letter from the IRS when you terminate a defined contribution plan. Now, defined benefit plans, traditional defined benefit plans, we almost always seek a formal determination letter, even though they may take years now because the IRS has gotten away from issuing them. But the termination of any defined benefit plan, cash balance plans included, are more formal, and that final 5500 for a cash balance plan is certainly something that I'm not going to call it a red flag in the IRS's system because I don't know that it's exactly true, but it is tracked. 5500s filed for cash balance plans or any defined benefit plan are more closely scrutinized than those for defined contribution plans. So when you terminate a defined benefit plan, cash balance plans included, 1 year after you adopt the plan, 2 years after you adopt the plan, 3 years after you adopt the plan, is it going to draw higher scrutiny than will something that is terminated after 10 years or 15 years or 20 years? Yes, absolutely. Highly likely, depending on things going on in the country that it will be looked at. Safe to say that almost no cash balance plans that were terminated in 2020 were or likely will ever be looked at. That's a broad statement, but I think it's largely true, simply because of what was going on with COVID. A lot of businesses experienced dramatic changes and had to terminate plans that had fixed and guaranteed contributions, and therefore they aren't really heavily scrutinized. But what do you do if something changes with your plan? What do you do? Well, when an employee has accrued or worked 1,000 hours during a given plan year, then they have then earned a benefit for that year, and that benefit has to be funded. Okay? So generally speaking, if you have a cash balance plan, by sometime in June, most, if not all, employees have accrued or worked 1,000 hours. It would be hard to prove that they didn't. And whatever benefit is determined for that year has to be funded. So that's the first thing. However, from plans prior to someone accruing a benefit for a given year, a plan could be frozen. Plans can be hard frozen or soft frozen. A soft freeze freezes new employees from becoming eligible into the plan. A hard freeze freezes both new employees becoming eligible and future accruals for the plan. So no new benefits accrue for an employee. So they're frozen where they are. So whatever we promised you might be available in the cash balance plan at age 65 or age 62, now we're freezing the plan today, and nothing beyond today accrues. We can amend the plan to terminate the plan once all the accrued benefits have been funded. So again, let me give you an example. August rolls around and it's determined that you can't fund the plan for the year. You don't have the money. It's just not going to be available. What do? Well, again, the benefits for that given year have already accrued. They have to be funded. They can be funded over a period of time. So we can freeze a plan, kind of put it into a parking place, if you will. The benefits that have accrued are a debt that the employer owes to the plan, but they can be spread out, if you will, over a number of years. There's a minimum annual contribution that's required. There's a maximum annual contribution that's allowed, and then there's the actual contribution that's made. And this chart just kind of demonstrates different contributions that can be made to a plan in either a frozen or pre-funded state. So we have our next test question here, a quiz question. Or polling question, I'm sorry.
This poll will be available for another few seconds for anyone who has yet to select an answer.
Excuse me. Thanks very much.
The poll will now be closed. Dave, you can continue.
Thank you. So, that the plan declares an interest rate. And we've said that employees don't get to choose their investments. And we've said that either the employer or the trustee or an investment advisor that they choose invests the assets of the trust. What's best, or what works out best, is when the interest crediting rate and the target investments of the trust match up to each other. So if we're using a 5% interest crediting rate, we like to see an investment advisor build a portfolio that closely targets the returns that are deemed in the plan. Doesn't mean they have to. Doesn't mean they have to pick fixed investments. A trustee or an investment advisor can still invest however they see fit. But we want them to, in a perfect world, match up the investment strategy with the interest crediting rate declared in the plan. Oops, you know what? I'm going to go back here 1 minute and talk a little bit more about this. Why is that? Well, first and foremost, it makes the administration of the plan simpler, but it also influences future contributions. So if the investment trust is overly aggressive, and instead of getting a 5% rate of return, it consistently returns 10% or 15% or 20% or more. And one school of thought might be, well, that's awesome. That's great. Well, what that means is that the funding that we showed you on a prior slide, all that money going in, well, you might have to cut back on that, because that was determined using, let's say, a 5% interest crediting rate. If you're actually returning 15%, then that 600 and some odd thousand or 700 and some odd thousand per year tax deductible contribution might only be 400 and some odd thousand or something like that. So that's one factor. What if you invest aggressively and it goes the other direction? What if you have losses, significant losses? Unfortunately, when an actuary is doing their work, they cannot assume in their actuarial computations that the interest crediting rate will correct itself. In other words, they can't assume that dramatic gains will reverse themselves back to the interest crediting rate of, say, 5%, nor can they assume that any losses will reverse themselves back to a positive 5% annual gain. They have to assume that whatever they're seeing in a given year is what they're going to get from then on, and they have to adjust the plan accordingly. So again, a $700,000-ish contribution per year might actually end up being $1 million a year when there are losses to the plan trust. So it's very important that the investment advisor or the trustee or the committee who is managing the trust target the interest crediting rate that's declared in the plan. Now we'll move on here to ideal candidates. And this is kind of a short list, and maybe a shorter list than I like. But for these plans that are designed in partnership with a 401k profit sharing plan with the goal of helping a business owner fund their retirement in a significant way, then typically what we're looking at are, again, owner-only employers, oftentimes medical groups, TPA firms, law firms, financial service firms, consulting firms. Hedge funds are listed here. I personally worked on a plan for a hedge fund at one time, a long time ago, perhaps 15 or more years ago. And actually their business didn't go so well, so they dropped the plan after a few years. IT firms. I think everyone in the audience gets the idea here is that entrepreneurs own businesses and can set their own destiny, and if they have if they're consistently profitable, highly profitable professionals and businesses. I don't know that it has to be highly profitable, but it has to. The business has to have money in order to do this. I will segue for a minute here that we sometimes get asked, what about businesses that have one-time big gains in a particular year? Not usually a good idea to target a business that has one-time, dramatic gains in 1 year because of some big something. We had a client several years ago that was a disaster claims adjuster, and they had some good years at that time, sadly, because there were a lot of hurricanes in the South. And then I believe they went for a couple of years without it, and we had to freeze their plan. They didn't have the profit to continue to fund it at the level that they wanted. Not so ideal candidates. No experience sponsoring a qualified plan. This should not be a first step for any business owner. Major fluctuations in profits. I mentioned that a second ago. Money going up and down, or hey, I had a great year and I don't want to pay taxes on it. Well, tell us about your prior year or the year before that, and tell us what this year looks like, and tell us what you think next year is going to look like. If the business owner really can't say that they know, it's probably not a good idea. Frequent changes in employee demographics can sometimes be pretty difficult for these plans to work. Top priorities that do fit with business owners: reducing taxes, controlling costs, keeping good employees, minimizing risk, cashing out their business and retiring. We have seen strategies. We don't consult on these. We consult on the plan, but we have seen strategies where a plan like this is heavily funded, and the employer gifts stock to their children who are going to succeed them when there is no, when there isn't sufficient cash available for the succeeding children to actually buy out the business.
Dave, let me stop you
Yes.
for just a moment. We're right up against our time, so we're going to go ahead and launch the last polling question so that we make sure that we get that in there.
Okay.
So we're going to do that right now. And we'll give it a few seconds for everybody to answer.
Sorry, folks, that I rambled on a bit.
We know you're passionate about cash balance, Dave.
Thanks, Beth. At least nobody has to worry about not getting their credit because I didn't go a full hour.
All right, the poll is going to last a couple more seconds. Okay, the poll is now closed. So unfortunately, our time is up. So thank you, Dave, so much for joining us today. And thank you to everyone who attended today's webinar. Any questions we did not get to today, we will follow up with you separately. And just as a reminder, please complete the survey question that will pop up on your screen in just a minute. And everyone have a great rest of your day.